I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, a best-selling author, a Harvard MBA graduate. He runs Dent Research. I gave it away. Harry Dent. Harry Dent, thank you so much for joining us today on USAWatchdog.com.
Yeah, nice to be back, Greg.
Well, you have the distinction on this site of having equally the almost equal amounts of thumbs up to thumbs down. So you're like Howard Cosell or I would say Howard Stern, that people either love you or hate you, but they all want to hear what you have to say. And you sparked some great debate and great commentary on the site last time. And I want to kind of pick up with the stock market. You back in 2004 said it was going to go way up. I think you said 35, 40,000. It went up. It didn't go up as high as 35,000, at least not yet, but it's gone way up. Where do you think we are in this ongoing scenario with the way the economy is going and this so-called recovery?
Well, I see what I call a big pattern called a megaphone pattern. We've had three bubbles now. The tech bubble that peaked in early 2000 and that next bubble in late 2007. And we did expect that to go higher because I wasn't taking into account the changing geopolitical environment, which obviously since 9/11 has gone just as bad as it could go. And we've had crashes each time. And now we're in a third bubble, which is even stronger. But each of these bubbles peaks at higher highs, and then they each crash to lower lows. So we're expecting the Dow to peak somewhere around here, somewhere, we've been looking for somewhere between 17,000 and 19,000. We're right in the middle right now. And then looking for an even bigger correction, likely into around late 2016, early 2017, because this whole bubble has been artificial. The ones before at least had demographic, technology trends we can measure, project behind them. We would be in a depression right now if it weren't for 11, 12 trillion of free money printed out of nowhere and bond rates at negative to zero. So this is a whole artificial environment. This has never happened before. But the charts look like to me we're either at a top or we're going to see maybe after a 20% correction a top later this year. But I'm telling people this is definitely the time to be cautious.
Wow, that's pretty, that's a lot of people who say the same thing. Now, there's some people that say the Dow people are going to be looking for assets, and they're going to, I think James Turk said the Dow is going to go way up from here, and I'm not trying to get you in a debate with James Turk because I like both you guys, but, there's a couple of schools of thought. You think it's going to crash and implode the stock market, and why do you think that? Why wouldn't money run into there if the bond market gets into trouble?
Well, I tell you, there's no question that money does want to run in the stock market. The stock market will go up unless something goes wrong. But we have demographic trends on Germany that are worse than they were for Japan in the 1990s. And I tell you, I'm the only person in the whole world that said Japan was going to crash in the 90s while the U.S. and Europe had their greatest boom in history because their demographics were horrible. Germany's is terrible, and they're supposed to hold up the euro. The China real estate bubble, which we've been warning about for the last years, it is starting to crack. In fact, it's starting to crack so much people are running into speculating in stocks, just like we did vice versa in 2000 when the tech bubble burst. Everybody in the U.S. ran and started speculating in real estate. So in Singapore was forced to curtail their bubble because the foreign buyers just basically ran everybody out of town. And so the Singapore is leading down there. So I worry about things like that. The Fed can't do anything about the China bubble bursting. And if Germany starts to be weaker and some other countries there, and Greece is about to exit or do something crazy, everybody acts like this is no big deal. It is a big deal, but I worry more about Germany getting weak than I do Greece exiting. And our demographic figures say the next couple years, in fact, the next 8 years, Germany's going to take a bigger dive than Japan did in the 90s, and that is nothing to sneeze at.
Well, I'm glad you brought up Greece and Germany. Greece and Germany are tied. I mean, that's why the Germans don't want to let Greece off the hook. I mean, it's a damned if you do, damned if you don't. Some people think that as early as sometime this May that Greece is going to do something. What kind of an effect will that have on the EU? What kind of effect will a Greek exit or a deal to cut their debt? What kind of a deal will that have on the French banks, the Italian banks, the Spanish banks, Portugal, Italy, Ireland, all the pigs, and including France is in some deep trouble. What do you think about that, the Eurozone?
Well, that impact is minor, is still substantial, and is going to impact the banks. What I worry about, Greg, is that the bonds, the sovereign bonds over there, and bonds in general in Europe are priced for perfection, way lower than here when we have a better economy. So what happens is Greek bonds start to spike up, and then other bonds start to spike up some, and then some more. this is going to wreck Mario Draghi's whole thing. The only way he's keeping a debt economy going is keeping bond rates down near zero long-term and zero short-term, just like we're doing here. He's just having more success at it, and when he can push the euro down from all this QE and stimulus, it has a bigger impact on Europe because they export a lot more than we do. So this is the biggest danger, is that it turns around this unbelievably low bond yield in Europe, and now how are they going to grow? It's the only thing they have going for them.
And Lawrence Kolikoff, he's professor of economics at Boston University. He's worried about bank runs. I was reading in Zero Hedge that they have with these bonds, 30 trillion in derivatives, at least in the bond market surrounding some of these sovereign bonds that's propping them up. Could that cause a daisy chain of effect on the banks and it roll over here, and we have bank runs and bail-ins in America as well as in Europe?
Well, that is what happened. I always remind people that the subprime crisis, it was just 4 states at first. It's primarily 4 states back in 2008. 4 states had a subprime crisis, and the whole world went down. Because when those loans started to go bad, then people worried about other loans. And when those loans started to go bad, junk bonds started saying, oh my gosh, we could fail. Right now, the same thing in the U.S. People are pricing high-risk junk bonds at 4, 5, 6% when they should be 8, 9, 10, and even higher. So that's the risk of what the Fed and central banks have been doing. When you keep stretching a bubble and keep blowing it up, don't let the economy rebalance. Don't let bubbles burst. Don't let loans be restructured. You just stretch the system farther, then all it takes is a pen. All it takes is something to start the worrying, because nobody's worrying about anything right now in the markets. So it starts with one thing like Greece, or it starts with some weakening statistics in the United States retail sales, we've said, and then all of a sudden Germany's weaker. How could this be? These things build, and at some point, yes, people start worried, bond rates spike up, and currencies change. The next thing you know, you got a crisis and the Fed's behind the curve.
Well, if that happens, if we have some kind of a Greek exit, a lot of folks here are talking about how John Williams says we had a 5% contraction in retail sales in the first quarter. Oh boy, that's pretty big, and it's his numbers, and I trust him more than the phony MSM numbers. Yeah, but there's a lot of people, either Jonathan Kahn, who looks at the biblical perspective, and also several other analysts say they think this fall could get really tough. What say you?
Yeah, that's what we think. I think this crash is finally going to start this year, and it'll probably be at its worst in late 2016, early 2017. Then we'll get a bounce out of that. But I expect new lows on the Dow. I expect the Dow to go to 5,500 to 6,000 in this next crash. But our fundamental cycles, our demographic spending cycles, geopolitical cycles, innovation cycles, and even our decennial boom-bust cycles do not bottom or start to bottom till around early 2020, and they don't really start to turn up till 2022 or 3. So we've got several more years of what I call this winter season, and so I expect stocks to be even lower by then. But I think the worst crash, just like in the whole late 60s and 70s and early 80s, that was a long-term downturn. The worst crash came right in the middle, 73, 74. I'm looking for that sort of crash. The biggest crash we'll see will come between 2015 and early 2017, but we'll still probably go lower several years after that.
The U.S. dollar and gold, and I will start with the U.S. dollar. You said dollar was going to go up, gold was going to go down. You've been right about this since, 2011 or so, and much to the chagrin of the gold folks. But then again, they're printing all this crazy money, and the bonds may not be worth something, so I can see their point as well to hold gold. But the dollar, do you think the dollar's going higher from here, and aren't multinational companies going to scream bloody murder that the dollar's going up?
I don't think from here. It's already had an incredible run. We've been predicting in our newsletter recently the dollar would set back. It hit about 100 on the dollar index. It would set back to maybe 94, give or take, and go sideways for a while. But my target is 120 in the next couple of years, that this deflation, just like in 2008, it was bad for gold, it was good for the dollar. We see that again. I think gold's going to bounce for several months now, but only a little bit, a couple hundred points at most. Then it's going to go crashing down again. So I say the gold goes up some, the dollar goes down some for a while, but the next turn is going to be, like everything else, bigger crash, gold down, dollar up. So that's the direction we still see. I just don't think it's going to happen quite yet.
Well, but you ultimately long-term think gold will go up higher from at some point it'll turn around?
I think it's going to bounce 100, 200 points in the next. so many months. In the early stages of a crisis, gold usually goes up because it says, oh boy, a crisis. That's what it did. It went up several months after stocks did when they peaked in late 2007. Gold peaked, I think it was in March, and then it crashed when it saw that the downturn was going to be financial institutions melting down, deflation in prices, not inflation. So gold is an inflation hedge. And when people say it's a crisis hedge, they're missing that 9 out of 10 crises we've had in the last century have been inflationary. It's an inflation hedge, period, and it's a commodity. The commodity cycle, we have another cycle, has been pointing down since 2008 to 9. It points down for another several years. Gold's going to go a lot lower. Our target for gold is 700 to 740 by early 2017, and ultimately it could see 250 to 400 several years down the road. But I see another crash coming for gold. I just think it's been beaten down. It went from 1800 to 1144 in a short period of time. So it's due for a bounce, but it's a dead cat bounce. And the gold bugs are saying, oh no, we're on our way to 5,000 now. The gold bugs they understand financial crisis. They understand money printing doesn't work. I agree with them 120% on everything they say until they say, here's what's going to happen. They haven't studied deflation. When debt is restructured, when financial asset bubbles burst, you are destroying. And I'm estimating over $100 trillion in wealth worldwide will disappear. If you create money by magic with QE and bank loans, it can disappear like magic. Now you see it, now you don't. When that money disappears, there's fewer dollars chasing the same goods. That's deflation, and gold's not going to like that.
Well, what about the $16 trillion? And I'm not debating you. I'm just trying to get my hands around this. John Williams says there's at least $16 trillion of liquid dollar assets held outside the country. Those are treasury bonds, government bonds. Aren't they going to want to make claims on that? I mean, what's going to happen to the world if the U.S. says, that's not worth anything? Can you explain that to me? Because what people like Williams say is all this money, and Jim Rickards, he wrote The Death of Money, they say, we've printed enough money already. We have enough snow on the mountain for the snowflake moment, and they're predicting hyperinflation because of all this foreign, holders of U.S. treasuries. Aren't they going to make a claim on those treasuries? And when they do, isn't that going to be hyperinflation? Or are you saying that they're just going to default on all of it?
Yeah, they're going to default.
So the U.S. Treasury, hold on, I don't mean to interrupt you, hold on. So the U.S. Treasury is going to default on all this debt. They're going to say, boom, we're not paying you.
Oh, no, not the U.S. Treasury. There's going to be defaults on a lot of that. People don't realize there's nowhere near as much government debt, near as much Fed-created money as there is private system-created money. Banks create most of the money. They lend against assets that aren't even theirs, your deposits, on a 10-to-1 basis. You only have to have 10% reserve. So they can take a little bit of money and create a lot of money. At the peak of the debt bubble, we had $10 trillion in government debt, federal government debt, $42 trillion in private debt. All these guys are looking at the government debt. They're looking at dollars this or held by China. That is nothing compared to all the dollars created in the United States, all the dollar-denominated loans. It's not so much treasury bonds outside the U.S. It's dollar-denominated loans. Most emerging countries buy in dollars. They buy and sell commodities in U.S. dollars. The U.S. dollar, our point is, what the gold bugs don't get, they get everything right except they don't get how fast this money can disappear. If there's more dollars, and there's 40% more dollars in the world than euro, when these things all melt down, and they'll all melt down, there's no good house in the neighborhood here. More dollars will be destroyed than euros, way more than yen, and so the dollar will go up in value because there'll be fewer of them. Fewer dollars chasing the same goods is deflation, and it paradoxically makes the dollar more valuable. The dollar already collapsed 60% in the Great Boom because we created so much debt in dollars around the world. So when we restore that balance, painfully, it's going to cause the dollar to go up.
Now, so you think the dollar will ultimately top out? Right now, it's at a holding pattern. It's going to go up to 120 from here, and you would have a big old stack of 20s if you had enough money to do that. You'd have 20. You'd be long cash money. Is that right?
Yeah, right. Because you got to pay to hold a bond, a sovereign safe, a quote unquote safe bond these days. You got to get negative yields adjusted for inflation. Yeah, I'd rather just have cash, and I'd rather have U.S. dollars. When I lecture in Canada or London or Australia, I tell those guys, not only put your money in safe stuff, put it in safe stuff denominated in U.S. dollars. We've been telling the Australians, your currency is going to go from 108 down to 60. It's already down to 73 recently. We've been telling people commodity price is going to collapse. Iron ore is down 70%. Steel, gold, silver, oil, all these things that people thought would go up, and Jim Rogers goes around the world, oh, there's not enough resources for all the new middle class, emerging countries. It's going down. This is deflation. Nobody's seen deflation in their lifetime unless you were young and half awake in the early 1930s, so people just don't understand deflation.
And you think that the boom is going to start this year? The crash may start this year, and it'll just fits and starts and go down, and it'll culminate in a super crash in 17. Am I getting that right?
Yeah, and by early 2017, and maybe earlier. We have a couple major turning points from some people I work with. Late March, early April is the biggest one for this year. I think it's possible the markets could be topping now. We have two scenarios. One is that we do get a near-term top. We get more like a 20%, a more serious correction, but governments come in one more time and do the rah, rah, rah. Everybody's going to stimulate at once, and you turn around, make a slight new high, and then you crash in 2016, or we're starting to crash starting about now. One of those two.
But what do you think about the recent numbers? Retail sales contracted in the first quarter 5%. This is according to John Williams' real numbers. And then unemployment ticked up. I mean, this is going to be ugly, right? I mean, there's going to be a lot of people without jobs. Prices of everything. You're saying the price of homes are going to go down. The price of commodities is going to go down. Price of fuel, gasoline, going to continue to go down. The only thing safe is going to be currency, dollars.
Dollars and high-quality short-term bonds. So you want to preserve your capital. We've had the greatest bubble in modern history, even greater than the Roaring '20s or anything else you can look at. When you're in a bubble like this, first of all, it's better to get out a little early than late. The first crash of the NASDAQ in early 2000 was 40% right off the bat in 2 months. So when bubbles burst, they go down twice as fast as they build, and they build the most in the last stages. The second thing is you just want to preserve your capital. People say, well, I got to get yield. No. If everything crashes and you're holding dollars that are the same, you're going to be able to buy 4 or 5 times as much of a lot of stuff.
Do you think banks will go under too with your scenario? You think the banks will go under and they'll just bail money in, as they've been, a lot of people have been talking about that. Official sources have been talking about bailing in, taking depositors' money like they did in Cyprus. You think that's going to happen? Something
of that, yeah. Somewhere they're going to have to deal with this, because last time, it started to happen and the central banks got ahead of the curve. This time, if they blow it up even higher, it's going to be a steeper downturn. But more important, who's going to vote for central banks doubling down and printing $20 trillion next time instead of 11? Remember the number I said before. This is a real number. There's $250 trillion in loans and financial securities around the world, all stuff that can fall dramatically in value. I see $100 trillion of that disappearing. So is the Fed going to create $100 trillion to make up for that deficit? I don't think so. I think they're going to be checkmated next time around. But that's why I say there's a chance we may get one more correction and one more rally, because they're certainly going to try again. I have no doubt that central banks will continue to do whatever. It's just, how long can you keep a bubble going? And the answer is nobody, and I mean nobody, not Zeus, not Hercules. Nobody can keep a major bubble like this going forever. You have to crash, and the longer you keep it going, the worse it'll be. So I'd rather this thing be over and get it over with, because if they last another couple of years, it's just going to be a bigger disaster.
Would supply lines dry up? Would we have a credit crisis as well? I mean, if we have deflation, that doesn't mean goods are aplenty. There's a lot of preppers that watch this channel, and they say, you should buy water and food and stock up on stuff, because not because A, it could go up in price, or B, you could just not find it. What camp are you in, or do you think you should you don't need any of that stuff?
No. At a time, if there's any time in your life you're going to do something like, hey, I want to have some safety measures, I want to have a place to go. I have a place to go. I don't tell anybody where it is. I have a place to go that I'll be just fine. But you need stuff like that. I mean, when the gold bugs say, well, you're going to need gold and silver to trade and barter, I say, no, give me shotgun shells. Give me little mini bourbon bottles. I want something that people really want, because gold and silver could go down. So, no, I think having stuff that you can survive on, having stuff you can barter with if things get worse, and they may or may not, but civil unrest, I've never seen our society more polarized. They were not this polarized when we went from the Roaring '20s to the Great Depression, the last such bubble boom to burst. I mean, we got half the country thinks this way and half the country thinks this way. The reason Congress can't get anything done is there's no middle ground.
And do you think we'll have civil unrest? I mean, you brought that up, Dent. You
Yeah.
brought up the thing. You're fearful of civil unrest when we do have this big destruction of debt, which is the classic example of deflation. Does that mean your EBT card doesn't work? Does that mean your money in your bank's gone? Does that mean your Social Security check, your veterans check, all that stuff, poof?
I mean, all of that's possible. I'm more worried about people unemployed. When people get unemployed, they get angry. And they somehow have to steal or whatever to survive. I'm more worried about that. The electronic systems has a lot of backup. It may go out of time. But again, I don't know. We haven't had something like this before. We haven't had money printing to this extreme to stretch a bubble this far. But on the other hand, we haven't had a global economy where emerging countries still have demographic growth and we don't. There's a lot of different things this time. All I know is I see a bubble building bigger. I see more tensions in society, especially in the United States, between the left and right sides. And so if we have a big meltdown, how could we not have some of these problems? I tell people where you live is as important as anything. If you have a choice of being in the downtown major urban area and be out in the exurbs, better. If you have a choice of living in the middle of the country in between the two mountain ranges rather than on the coast, better. If you have a choice in living in a bubble area or not, don't pick the bubble area. Wherever there's the biggest bubbles and the biggest crashes, there's going to be more people losing jobs, being thrown out of their homes, destitute, and more money lost and more trouble. So it's just common sense. I don't know how bad it's going to get, but I'm leaning towards the worst side precisely because the government has now extended a bubble that should have peaked in 2007. And we peaked these things, the whole baby boom peak, all this stuff way back. Should have peaked several years ago, and they've kept it going and around the world. In China, don't even get me talking about China. The last place I'd want to be in this world today, I would be in Somalia before I'd be in a big Chinese urban city, given what they've done, how great a bubble they've created.
And finally, people like Catherine Austin Fitz, who I've had on before, she says that one of her things that she says, well, before we have a big crash, we'll have war. What do you say about the war front? There's plenty of places to get it started in Ukraine and all over the Middle East. And what do you think?
You know, I tend to think war has come after. We're in a what I call winter season. We're deflating a bubble. In the 1930s, we didn't have a major war. The World War II came after it. All the unrest and civil unrest and unemployment. What did Hitler play off? High unemployment and people who were very, very angry and had nowhere to go. So I worry about that. We do have a geopolitical cycle among a number of key cycles that started pointing down in 2001 with 9/11, and it doesn't turn around until sometime in 2020. So geopolitically, we do have a window. I don't think we're going to have World War III, but Yemen is the seat, the spark for a Shia-Sunni war between Saudi Arabia on one side and Iran. Those are the two major powers. I worry about that. You see Putin. His economy is sucking wind and oil prices going down and stuff. He needs to move into Ukraine if he can. He will if he sees a shot. So there's definitely going to be geopolitical stuff. I don't see World War III because I don't see two major powers that could fight each other to that extent.
Harry Dent, founder of Dent Research. You also have a free newsletter. You send me the links. I'll put them up afterwards. Harry Dent, thanks for coming back on and feeling the heat and coming back on. And listen, a lot of people liked you last time. Shrug off all. There's a lot of trolls too, but thank you so much for coming on USA Watchdog and giving us your view and an update about what's going on in the world.
Okay, thank you, Greg.